Good morning. My name is Joe Scarice. I'm a direct nationwide lender for Lend Investor Capital, and I'm really excited about this event starting every second Saturday of the month at 10 a.m. with the Real Estate Mastermind Strategies here at TCS Property Management on the penthouse floor at 2nd and Chestnut, where I'm a licensed real estate agent as well. And I've been in the investing space now over 20 years as a licensed banker and a licensed agent, more like 36 years. And the Real Estate Mastermind Strategies has evolved over the last decade in coordination with Mr. Yordell Perkins of Perkatech, who is my social media administrator, my business partner and co-founder of the Real Estate Mastermind Strategies, as well as the Creative Birth Strategies podcast. And very excited about where the podcast is going, because we provide weekly, every Sunday morning, 9 a.m. Eastern Standard Time, education, networking, and strategy. But we are focusing on a one-on-one interview every second Saturday of the month here at TCS with a different real estate professional every month as well. Whether we have attendees, this will be broadcasted out to thousands post-production. And I'm really focusing on branding one-on-ones to the people that I'm going to have, I feel like, in my team of experts going forward. So today's discussion is on cost segregation. And for the last couple of years, for whatever reason, post-COVID, it seemed like all the cost segregation guys just disappeared. Everything like poof. Before COVID, you had everybody knocking on your door, hey, can I do a cost seg presentation? Can I do a cost seg presentation? I found that very unusual, but maybe a lot of this went virtually. And a couple months ago, David Bergio, who is my co-host up in the Lehigh Valley, where we host a monthly event at Fegley's Bethlehem Brew Works, second Wednesday of every month, he invited a colleague of his, Mike Henninger, to just come to the event. I briefly met him and his wife, Karen, and it's nice to meet everybody there. And we had a large crowd, so I only could give so much time and attend, with the attendees. And I'm like, oh, you do cost seg? Phew. That's weird, because the last 2 years I can't find anybody to even call me back. And I found that interesting, because when I'm talking to clients, whether they're purchasing a property or refinancing a property, I'm going to say 80 to 90% of them don't know the disadvantages or the advantages to cost segregation. So I invited Mike to be my first candidate and colleague to come on to our one-on-one podcast here every second Saturday of the month. I thought it was perfect timing here. And I'm very excited about having him here to go over this, because I want to kind of sift out some of the confusion, why I think cost seg is so important. So maybe we'll peel that onion and see what's at the root of it. Mike, I'd love you to introduce yourself, and thank you for coming here this morning.
I really appreciate the invite. It's nice to be here. My name is Mike Henninger. I have a company called Main Street CFO, where we do fractional CFO and advanced tax advisory for the real estate, construction, and syndication industries. This topic specifically comes up a lot in the sense of trying to maximize the tax code in a way that benefits the investor and the owners. And there's a lot of caveats that are kind of glossed over when people initially talk about cost seg, and I'm hoping we can kind of get into those and understand how to maximize it for the most tax advantageous way.
So let's just break down the first question, of course. What is cost segregation?
Cost segregation is it's an IRS approved strategy, in a sense, that allows you to take an income producing property like a residential rental property or a commercial property, and carve out pieces of that. Normally those assets are either depreciated over 27 and a half years or 39 years. And that's a long time, right? If you have a property that's, after you carve out some land, your basis is now $275,000, that's only $10,000 a year in depreciation expense that you can take over the course of that 27 and a half years. What a cost segregation study says is, look, here's this building, but there are probably components within it that should have a shorter life. And the cost segregation study allows you to go in and analyze the property and carve out those pieces and dump them into those shorter life buckets.
So how can cost segregation studies accelerate tax deductions for real estate investors, and what are the typical recovery periods for reclassified assets? And we talked about this before we even got in the podcast. Is the 10-year depreciation way to go? Is it a 15-year? I mean, again, most of these clients are taking out 30-year mortgages.
Right.
So what's the benefits and negatives to all this?
Well, what a cost seg does is it allows you to go in there and it says, okay, here's this asset worth X. Let's carve out certain assets that have a 5-year life, a 7-year life, or a 15-year life, depending on what type of asset it is. And instead of depreciating over that long period of time, we're taking it and dumping it into the 5-year, 7-year, or 15. So it's not really a 10-year thing. Maybe on average it is, but it's taking an asset that you're basically going to depreciate over 27 and a half or 39 years, and now you're compressing it into 5 years or 7 years. So it takes that expense that was going to be drawn out over that lifetime and pushing it all the way into the first 5, 7, or 15. So that in a sense, it takes that depreciation that you were going to get anyway over time, and because you're putting it into that smaller bucket, elevates the amount that you can deduct in those early years.
So the benefits of a single family through 4-family rental property, let's start small, right? Let's not talk about the 5+ multifamily unit. I think that's a different animal. So somebody owns 2 or 3 properties. They're taking 30-year money out on a non-QM space, which I'm in a non-QM space. They're not going to the banks anymore, the credit unions. They're going to a DSCR lender.
Right.
You know, maybe a local bank or broker is doing some non-QM, but they're kind of regulated. We're not. Mm-hmm. We follow guidelines. So I'm offering 30 or 40-year money advertised. Okay, so that's crazy anyway, because
for sure,
you know, we're all going to be dust in the wind maybe in 40 years. But I mean, so from a single family through 4-family space, what are some of these benefits to that investor in doing this? Because the average investor does something every 7 years with their property, per property. So if they own 5 properties, they're doing something or another, whether refinance or selling off or doing something with that property. So what type of advisory would you suggest there? And the benefits. Let's talk about only the benefits of the single family through 4-family space.
The benefits are going to be, like I said, we're taking those an expense that, like I said, was going to be spread out over a long period of time. We're able to take those losses up front. What that does for the investor is it allows you to front load that property with depreciation expenses that are much higher than they normally would have been. When you throw in something like bonus depreciation, which is basically if you have an asset that's a 5, 7, or 15-year asset, you can deduct that 100% in that first year. So technically you could carve out, let's look at an example. Suppose we had that same asset we talked about, $275,000 is your basis. Say we carve out, if $100,000, that is actually 5, 7, or 15 year. We are now taking $100,000 that was going to be depreciated over that 27 years and taking it all at once. So we have $100,000 potential deduction against that rental property. Now, the reason that's important is because that generates these passive losses that can, under certain circumstances, wipe out ordinary income or other passive income. Now, that
goes for either 1 through 4 or a 5+ unit. So, what do you consider passive losses, and how are they different from non-passive losses? And I'm going to give you some examples. Okay, a BRRRR strategy. A supposed BRRRR strategy. No BRRRR strategy is perfect, but let's talk about BRRRR strategy. You refinance at either 65, 70, or 75% loan to value, right? Whether it's cash out or cash neutral. You decide, hey, the 70% looks really good, cash neutral, but I'm going to have $15,000 stuck in the deal that I put into the deal, up and above the construction costs, the draw schedule, other bells and whistles that come up in the cost of close, prior, during, after. I had a staged property, wasn't in my budget originally. So what does that look like if I have $15,000 stuck in a deal? How is that? Is that a loss for me in the cost seg world? What is that? How's that looked at? Well, and how do I capture that using cost seg?
The depreciation itself is irrespective of the loan, right? We're talking about the purchase price of the asset, maybe addition, maybe CapEx that we do down the road, capital expenditures that we put into it down the road, improve.
Well, it's down the road too. Like you buy a property or you buy a car, you're always gonna have to put money into it. It's not like you're like the perfect property rehabbed on a burst strategy. You're still gonna have outlay over the next X amount of time. But from the short-term perspective, instead of capturing all your money out, you want to get the better rate on the 30-year fixed. And instead of taking cash out, you save maybe a half a point, three-quarters of a point on the rate, but you're leaving 10 to 15 grand in the deal out there. Is that a loss in the eyes of cost seg?
No, when we're talking about cost seg, we're talking specifically about depreciation. So if you bought the property cash, or through debt, it doesn't matter. It has no impact on the cost seg piece that we're doing. What we're talking about passive loss is what a passive loss is. It's a loss generated by an activity, either a trade or business in which you don't materially participate, or all rental property, right? So those passive losses will only be deductible, generally speaking, against passive income. Now there's some.
So it takes me 3 months to start renting the property. Because the average days on the market of a rental right now is somewhere between 2 and 3 months, depending on the timing of when that rental is ready. Right? If that rental is ready December 1, that might not get rental till February. So you've got 2 months out there that you're paying the mortgage.
If it's ready for rent, we're okay. Yeah, we're ready for as soon as it's ready for rent, we're good.
So I come to you with a client that's going to do no cash out. He's going to leave a little money in the deal, 10 to 15 grand, or I'm going to bring you a client that has no money into the deal with the cash out. It was perfect. It went seamless. But he's going to also have 2 months of non-occupancy where he's going to pick up that PITIA for the next 2 months. What suggestions are you giving for those two type of clients, two different scenarios? Well, the one that's leaving money in the deal, the one that has no money in the deal, but they both have DOMs on the rental capacity of the income production 2 months out.
With respect to the depreciation, we can't start deducting anything until that's ready for rent. Like in any instance where we have a business, right? Lemonade stand. We could buy all the money for the sugar, the lemons, the stand, all that kind of stuff, right? We're not in business yet. We're not in business until we sell that first cup of lemonade. Once that first cup is sold, we're in business. Same with a rental property, it's when that thing's ready for rent. So regardless of what's going on the financing side, when that thing's ready for rent, we're live.
That's when we start having communication. Then you could dig into losses that can be either recuperated or acknowledged in that next year tax bracket, that next year tax.
Now the losses that come from a cost segregation study, and especially when you start throwing in the bonus depreciation, that's something that from a tax guy's standpoint is a little bit annoying in the way that some of these cost segs are sold. They talk about the huge losses you can generate, which are great, but you need to have passive income to run that expense, to run that loss against. You need to either be a real estate professional, you need to have a short-term rental loophole type of thing, or maybe you can deduct up to $25,000 if you're an active participant, you're an active investor.
So Mike, where do you, if I look at a flow chart, I have a CPA, I have a bookkeeper. Is my cost seg person, am I a cost seg expert, part of that triangle? Or are you both three?
The IRS,
If that makes any sense.
Yeah, well, the IRS doesn't say, here are the requirements of a person. You have to have a license, you got to do this, you got to do the cost seg study. What it says is that you should know something about real estate, you should know something about engineering, you should know something about tax law, because and you should know how to put together the report that can back it up. For our clients, a lot of times you can pay a company to do it. They'll send out an engineer, they'll do all that kind of stuff and do the whole report for you. There's also, I think it's DIYcostseg.com or something that they'll do it based upon the information you give them, and they have an audit protection piece to it that it's like $200. If you're ever audited because of it, they'll then send an engineer out to do the full-blown study, right? So you just want to have somebody that's going to back you up in case you're under audit. Now, a cost seg itself does not trigger an audit. It's not something IRS says, oh, cost seg, we're going to audit. There are certain things that they look for that can say, it's a red flag, right? If there's no photographs, if the documentation seems kind of weak, if it's not put together, substantiated by anything else in the area, like those are the kind of things that they look for when you have a cost seg study. But it's not something that's going to automatically trigger an audit.
So a CPA welcomes you, a bookkeeper welcomes you, because you're giving them engineering structuring to how to protect their clients for the most part.
Yes,
From an independent perspective.
right. I think a CPA actually could probably do the cost seg study.
I think that's a reach, though.
I would prefer having somebody that has the engineering background. If I in the event that I had to substantiate.
Yeah, I'd rather keep everything separate in boxes to me. Like if I was going to scale to 10 to 15 properties, my bookkeeper's doing this to protect me from my CPA that's doing this.
Yeah.
And I think my cost seg professional should be protecting me from the other two parties in my mind. I don't know.
Yeah, we try to kind of quarterback the CPA.
You're giving certain information to them, to the bookkeeper, to feed to the CPA to have better results on your bottom line at the end of the year in taxes. So what defines a passive activity under IRS rules, and why is real estate investing often classified as passive?
A passive activity is it's a trade or business in which you do not materially participate, or any rental property or any rental activity, right? So the reason most real estate, and we're not talking about flipping houses or anything like that, we're talking about strictly
holds.
Strictly holds. The reason is because you're generally going to be passive in that. That's a passive activity, right? And unless you can meet the real estate professional status, the reps, you're not going to be able to offset those. You're not going to be able to utilize those losses against your other income unless you do something like a short-term rental loophole, or if you have a modified adjusted gross income between or less than $100,000, you can deduct $25,000 of passive losses against your W-2. But there's a phase out, whereas it's like every $2 above $100,000, you lose $1 of that 25. So by the time you get to 150, it's completely phased out. So if you're a large investor or you have a large W-2, that 150 is going to wipe you out of that $25,000 piece. So.
Well, happy to say non-QM lending is expanding their platform in the DSCR space to not just DSCR long-term leased properties. They're also acknowledging and recognizing STR, short-term rental. They're acknowledging midterm rental, and now they're accepting pad split.
Yeah.
Which is very interesting. I didn't think there was going to be an acceptability to that because, at the end of the day, a pad split is a glorified boarding house.
Yeah.
You can call it whatever you want. But lenders like that if you're working with pad split directly or Airbnb directly or some type of midterm rental company, like a midterm rental company, that could be Airbnb as well, I would assume, or Vrbo. They have a P&L or a trailing 12 or a trailing 6 or whatever.
Yeah.
Does that help you in the cost seg evaluation to that?
Well, one of the three that you mentioned, short-term rental, is a massive play for the average person, because the reason the short-term rental is so nice in the sense from a tax perspective is because the standard to participate for the material participation is much lower, right? You have to have for short-term rental, you have to have 7 days or less on average of your stays. You need to perform at least 100 hours of material participation and more than anybody else. And you can essentially turn those passive losses into ordinary losses. You can use those passive losses generated by the cost seg, by the bonus depreciation. It transforms those things that if it was like a regular long-term rental, those losses will be sitting there in the passive world. If it's a short-term rental and you meet those criteria, it transforms them into things that you can utilize against your W-2 income. It's a huge play on the tax strategy.
I mean, I see non-QM welcoming you more than ever before because of the volume of direction of the investor now. Nobody's going to the credit union or the local bank because they're only offering 5-year money.
Yeah.
Typically on a 25-year amortization. Here it's a 30-year am or a 40-year am, and they're acknowledging all these unique products that are out there without a lot of documentation. We don't care about tax returns and all that stuff. So, pay stubs, W-2s, 1099s. So very credit related and related. And that ties into like my next question. How does the material participation test determine whether real estate losses are treated as passive or non-passive?
What is the material? Okay, well, the IRS has a set of 5 or 7 tests to determine material participation. So if you meet one of those, right, and you also meet the other hours requests for a real estate professional, then those losses any losses that a real estate professional generates, passive or otherwise, will be able to be used against their other income. But the reps meeting that reps requirement is not easy, and it's looked at very harshly by the IRS to make sure. And you have to log your time. There's like 750 hours in the real estate. Where I can get you the list of things, but it's not easy to meet reps. The short-term rental, the material participation is, like I said, it's like 100 hours and more than anybody else. It's the threshold to meet is much lower than if you're trying to do it through reps. So material participation is a big deal because if it's a trader business in which you don't materially participate, it's passive. And if it's rental properties in general, it's passive, unless you can meet those material participations.
So what is the $25,000 special allowance for active participation in rental real estate activities, and who qualifies for it?
So in real estate and tax, we talk about material participation and active participation.
This is per property, right?
Yes, right. Well, good question. There are certain grouping elections where you can group all of your assets together.
Okay, you ready? Non-QM welcomes blanket loans. So we could blanket multiple properties at the same time. So if I have a client that has 4 properties and they want to blanket them into a portfolio loan, it's going to be one mortgage, one closing, one fee, but 4 rentals. How does that allowance work?
Well, that's on the funding side, but as far as
What do you see?
from where I've seen the material participation, if you don't do that election, you have to materially participate and meet all those things on every property, which is almost impossible. But if you group them, then if you do the 500 hours of material participation for one of them, you're covered because
It's for all of them.
because you group them all together.
It's going to be most likely an umbrella policy on those properties, say hypothetically.
So getting to the active side, then the active participation is a much lower threshold. Basically, you're just like picking what tenants you want. The threshold is much lower, but you do have that phase out issue that we talked about once you get to 150.
Okay. What happens when a property that has had a cost seg study is sold? Depreciation recapture, what does that all look like?
That's another thing that is not often talked about. When any depreciation that you have, and let's just start there, any depreciation that you have over the course of the life of that asset, when you sell it, you have to recapture that depreciation as income, right? So it could be like 25%. So if you do a cost seg on a property and sell it 3 or 4 years down the road, you just took all that depreciation up front. That's now going to be captured again. So it's just something that it's not a negative. It's just something that you have to be aware of and may impact your decision. If I'm going to sell this thing in 3 years, why am I doing a cost seg now? Because I'm going to have to recapture it anyway.
So how does that tie into a 1031?
Well, your 1031 allows you to move all that without having to deal with it. You're just moving all that into the next. Your basis kind of stays the same, but you're just moving all that gain into the next property, including the
cost seg.
Yeah.
So then you tie into a 1031 expert as well. Funny enough, we have a 1031 expert speaking Wednesday night in Lehigh Valley.
1031 is awesome because you could essentially keep rolling that thing forward all the way down the road. You die, and then just say you bought this for $100 grand, right? $100 grand keep rolling it into something else, into a property now that's $1 million, right? Your basis was just say your basis was 100. This thing's worth $1 million when you die. So if you sold it, or if you gave it to your heirs prior, they have this gain, this $900,000 gain to deal with. If you pass, and it's worth $1 million, your heirs get it. That's their basis. They could sell it 3 months down the road for $1 million, no capital gains. It's
very interesting.
Beautiful.
It's so interesting how I'm placing the subject matter to kind of tie back right to you.
Yeah.
Didn't even connect the dots. The timing of it. We have the 1031 discussions here in Philly and in Lehigh Valley. And then you and I are doing an interview again in Lehigh Valley in January, so it'll be a nice.
What we'll do for that one is there's a lot of these things now. The caveat: this isn't tax advice, but right? It's not, and you want to make sure that whatever we talk about, you're talking to your tax professional about.
Of course.
And that's a specific example of something that the next one, I'll have the T's crossed and I's dotted. So we talk specifically about
absolutely
making sure all those things are
absolutely
covered.
Let's see here. In what scenarios can passive losses be carried forward to future tax years?
So in the event that, let's just say you're a passive investor and you're in a syndication, right? You're a passive investor in that, or you're just a passive investor in anything. And you do a cost segregation study. You think you're going to generate all these losses that you can use against your taxable income. You realize you can't because you only have this giant W-2 and you have all these passive losses. They don't match. You don't lose that, right? Those losses will continue carrying forward until you either have passive income to offset it, or you have a triggering event like you sell it. Once you sell it, boom, we take all of them. It unlocks them.
So how are losses generated by a cost segregation study treated at the partner level? So you have let's say you have an LLC owns a property and there's 3 partners. How does that flow?
What happens there is, and this can be just a regular partnership, it can be through a syndication, regardless, the partners are passive. So whatever the tax stature of the partner is, that's how they're going to be treated. They may come through and show as passive losses or however they're shown in their K1, but it is based on the individual's tax facts and circumstances.
Not percentage of ownership?
Well, that's the amount that will show up on their K1, but how they apply those losses will be determined by the facts and circumstances of the individual taxpayer. So that person, right? Every one of these partners is going to take their K1 and put it on their 1040. If they have other passive, if partner A has a bunch of passive income, cool, they can use those against it. If partner B has no other passive income and it just has W-2 income, and this loss is going to sit there in the bucket until they have a triggering event.
So let's see here. In a scenario where a person has significant W-2 non-passive income, how could cost segregation on a new property help optimize their overall tax strategy?
They could use the short-term rental loophole that we talked about. If their spouse qualifies as a real estate professional, then they qualify. So you could essentially have your spouse jump through the hoops to become a real estate professional, which they could do if they're non-working and they don't have any other hours that they have to compare their real estate hours to. The spouse being a real estate professional will allow all those losses to be utilized against the W-2 income.
So a lot of these real estate professionals are out there, hey, I got to find something before the end of the year. I got to find something before the end of the year. It doesn't sound as important than cost segging some of your properties. Or is it, like I just met an investor last night. I got to get another property before the end of the year for my taxes. Right? So now they're in crisis mode. They think they're in crisis mode.
Right.
Are they? If they already own other real estate holdings?
It depends on what those other real estate holdings are doing. If they're generating a ton of rental income with these other properties and they want to get in, create losses on the new one, probably to make sure that they do that election, the grouping election, all that kind of thing, make sure that they can use those losses against the other. Yeah, I think it could make sense to do that because you need something where you can generate these kind of the paper losses to offset this other income.
And it goes back to how does cost seg studies play? It's so funny that it only plays into short-term rentals and how it's not playing into is short-term rental and mid-term rental the same thing when it comes to cost?
It's for everything. The short-term rental loophole allows you to utilize those losses without having to meet all those material participation things of reps, or if you don't have any other passive income, or you're just a W-2.
Yeah.
Short-term rental loophole kind of allows you to kind of jump to the front of the line with your losses and utilize them against your other W-2.
So is pad split in that classification too?
Rental properties, yes. Rental properties.
It's all temporary stuff. So that STR umbrella, I think, falls in within MTR and pad split now. which is interesting. We'll definitely you'll have to look into that a little more, because pad split is obviously a newer
very new
thing that's being added to the repertoire of the investor, and a lot of people find it appealing.
Yeah, but no, a cost seg can be done on any rental. It doesn't have to be short term. I'm just saying it's easy. Sometimes it's easier to utilize.
I'd be interested in how it's how pad split ties in, because it is more of a temporary stay. It's almost like a hostel.
Yeah.
A glorified hostel in a way too. So what are some common pitfalls or IRS audit triggers related to cost segregation studies?
Well, again, it's not a trigger per se as far as triggering an audit, but like I said, they do want to see that it was done by something that somebody that has knowledge on engineering, has knowledge on tax law. They want to make sure that maybe there's sometimes if there's no photographs, if there's no if the substantiation for what they're discussing is not strong. Those are some of the things that they look at.
So who's qualified to conduct a cost segregation study, and what documentation is typically required?
It's not that they require a specific certification or anything. Like I said, they just want to make sure that the person has expertise in what they're talking about. An engineer usually will help, because an engineer clearly can look at the building and see. Like a lot of the things are going to be maybe we have an asset that we're going to dump into the 5-year bucket, right? Well, the electrical to that can be part of it. So me looking at this, I'm not going to know where the electrical is or how far back. So an engineer comes in and will say, look, this 5-year asset has an electrical system that should be included as far, with respect to this cost, right? And they'll do that with some HVAC and all those types of things. So you want to make sure that somebody that understands the tax with regards to the different types of assets and what qualifies for those buckets, and has the engineering chops to be able to carve it out.
So walk me through, like I'm in 3rd grade, okay? I make an introduction to one of my clients. What are the first 3 or 4 things that they need to be prepared for to allow you to start some form of evaluation to see if it makes sense?
I think the first thing that we do, it is the first thing that we do, is we want to take a look at their overall tax picture. We want to look at probably 2 years of tax returns. We want to see what else they have going on right now, kind of do some kind of pro forma projection where what their income is going to look like, what makes up that income. Can they in fact utilize this thing in the year we're looking at doing it? Because it's a waste of money if you can't utilize those losses. Or maybe you want to generate, maybe you have something down the road that you're going to be dropping, that you're going to be doing, and you don't mind having those losses suspended. You just want to make sure that you're doing it for the right reason. That's all.
Crazy question, because it just came to mind. So it's not a crazy question anymore. Can you cost seg anything other than real estate? Like businesses,
Their
equipment.
It's on the building.
So if I own the building and I have a pizzeria, I have a pizzeria, I have ovens, I have tables. There's a lot of use tax. Can I cost seg the pizzeria somehow into the building if I own the building?
Yeah. Yeah, you want to do.
There's sales tax and there's use tax.
Well, you want to know, like, are those ovens? Could we carve out those ovens? Are they part of the structure of the building? Probably not. So we can carve those out and put them into their own bucket.
So the real estate business owner that self-owns, owner-occupies a property can still take advantage of cost seg for their businesses as well. Yeah. So from the mixed use perspective,
it's on the building.
We're those SBA kind of guys and gals with that mixed use type of component that qualifies for that as well. This came out from the conversation itself.
The cost seg is really on the structure, the building, right? Whether or not residential, a pizzeria, whatever it is, it's the structure. And we're just trying to say of this building, what really is structural, which isn't, which is something that could technically be removed and not, like the TV. If maybe you bought this building and that TV came with it.
Yeah.
You don't want to throw that in 39 and a half years. You want to say, no, I want to depreciate that over 3 or 5.
3 years.
So not 3, but 5 or 7 or 15.
And most people scrap those kind of TVs every.
Yeah, but you know what I'm saying? It's clearly not part of the structure of the building. It shouldn't be depreciated over 39 years.
And that's what if you just allow your CPA to do it, they'll just do that, because if you're not giving them any type of advisory or suggestions otherwise. So that's why I think you got to keep, even though CPAs do cost seg as we were discussing, I think you really need to keep them separated. I personally think so.
Or at least working with.
Yeah, they know you have somebody like kind of overseeing that.
Yeah.
Okay.
Yeah.
So we have some audience members that decided to come to our podcast, which is always nice. Michael, do you have any questions in regards to cost segregation with Michael? Nothing comes to light? It's all good, right? It's something, you know what you know, and you know what you don't know. Christine, do you have any questions in regards to cost segregation with Michael Henninger?
To be honest, this is great. I'm just soaking everything in.
Okay. Yeah, Mike, I really appreciate it. This was definitely a good setup to our live event for our audiences in Lehigh Valley. And we'll definitely get you back here in Philadelphia for a Monday night event. So I'm excited about that. And I really look forward to doing that type of introduction handoff as I'm underwriting refis or purchases of SFR 1 through 4 and or 5+ unit multifamily. And now the owner occupied mixed use, which I see some of that, not a lot in the non-QM space. I'm seeing more fixed to rent, fixed to flip, new construction discussions. But I think this all applies for a good handoff with a proper football.
Yeah, the nice thing is that when you're, working together, we can, some people that are involved in buying the properties, they may not know, like tax advising and tax strategies sometimes is just, the difference between getting a huge deduction is just like flipping one switch over here. One thing that I can do differently. And not everybody knows that, right? So if you have somebody that is considering they want to buy this other property, maybe there's just a couple things that need to be tweaked here for them to generate these massive losses that they can utilize against their other income. And I think working in conjunction like that to kind of discuss those things and looking at a person's overall picture gives them just the ability to make those decisions a little bit smarter.
Oh my God, I really appreciate you coming out to our first grand opening of our second Saturday of the month Real Estate Mastermind Strategy podcast every second Saturday. And I look forward to ongoing other events and hopefully other people within your team of experts as well. And we're going to get this out. It'll be posted on Facebook and LinkedIn and YouTube and then popped out to Spotify and the world. And I really appreciate this time today. And how do we reach out to you if we want to have a one-on-one strategy to see, does it make sense or does it not make sense?
The website is mainstreetcfos.com. Go there. There's a ton of links to get on the calendar. And, we'd be happy to talk to anybody that wants more information about it.
Mike, thanks for coming out today.
Thanks for having me.
I want to thank everybody for listening in. I want to thank a couple people today. I want to thank, obviously, our attendees that decided to come in here on TCS Property Management at the rooftop at 2nd and Chestnut, where I'm a licensed real estate agent providing property management services and real estate services. I'm a nationwide direct private lender. I'm with Lend Investor Capital. I'm Regional Vice President of Sales, providing not just direct to investor, we're now offering a full-blown training module for individuals, real estate professionals, to broker our money. It has all the guidelines, white label products, matrices, products and programs. Once you are approved as a broker, you will have full accessibility to take your business to the next level. We also have a referral program where you could just refer business. Don't have to broker, don't have to get white labeled up. You just take the referral fee and make the same equivalent amount of money. You just don't need to get as dirty with the client and go down that rabbit hole. And I'm very excited with this ongoing relationship we have with Perkatech, with Yordell Perkins, who is really the backbone to not just this streaming of this podcast going every second Saturday of the month, but Sunday morning, 9 a.m. live on Clubhouse, live on our podcast, that we're providing consistent content and education to our listeners. We are celebrating our 150th episode on the podcast. You can go to our websites. One, you can go to perkatech.com for Yordell's services on the social media side. For me, you can reach out to me at josephvscarice.com. And the beauty of there is that there's an events link. So if you miss an event, you want to find out where we have events over the next couple months coming up, they're all there. You don't have to try to search it out. It's on the website. And if you go to the creativebirdstrategies.com website as well, guess what? There's an event link. And you go into the event link, it's the same one. And it'll tell you where we are and who we are and what we're doing November, December, January. So we're always 3 months out. We're always 3 months out of good education context. So thank you for listening today, and look forward to our next discussion and having Mike again back in Lehigh Valley in January as well. A couple points I wanted to just make sure everybody's aware. We have some great events coming up here in November. We have Monday night, we have a discussion on understanding 1031 exchange. And then we're going to have that gentleman back second Wednesday in November up at the Lehigh Valley in discussing understand 1031 exchange. This coming Saturday is our white label underwriting course where we're rolling out all of this about what's going on at Lend Investor Capital. It'll be 9 to 3. I put purposely in it 9 to 5 so I could scare off some people. But I'm doing it 9 to 3. I just lied a little bit. So if you sign up for it, there's going to be a special happy hour Friday night for anybody that can attend that's coming to the 9 to 3 class. And we're going to do some one-on-ones and talk about all the good, the bad, and the ugly. I'm very excited about this. We're going to have this white label course once a month somewhere, always. And then third Monday, I've teamed up with Joe Hernandez up in Newark with Jumpstart Newark and Van Robinson. And we're having an event third Monday of every month going forward at City Rub in the back end of the Ironbound in Newark, right on the borderline of Newark and Jersey City. And we'll always have an educational subject there. And of course, we have our podcast, our Creative Birth Strategies podcast, which I'm partnering with Yardell Perkins of Perkatech every Sunday morning, 9 a.m. We have subject matter booked out 2 months in advance every Sunday morning. So we have so much trying to give back and provide and hopefully collaborate and partner with you in a team of experts. So I want to thank you for listening in today. This is Joe Scarice again. And if there's any questions, if you're interested in being one of the interviewers or interviewees, for our podcast on second Saturday or even the Sunday morning discussion, please reach out to me directly at 215-290-5108, or you can email me simply at joseph@josephvscarice.com. And thanks a lot, and we'll see you again soon. Thank you, Michael.
Thank you.